Hi traders, you're welcome back to the Forex Geek channel. What if I told you that those beautiful double tops and double bottoms you are marking on your charts are actually traps? Well, welcome to the world of equal high and equal low liquidity, where smart money plays chess while retail traders play checkers. Yeah. Meanwhile, in the forex market, when price forms equal highs or equal lows, most beginner traders see these areas as strong support or resistance. It's quite easy, to find equal highs on your chart. It's just areas where you have price getting to exact around the same price point, right? You can see something like this around the same price point. This is what we call equal highs, right? And then for the equal lows, is a similar case. You have price getting to around the same price point below, right? As the name implies, equal highs is above, right? Two highs that are around the same price point, equal lows are below. Two instances, two instances whereby price comes towards almost the same or exactly the same price point. Okay, so retail traders, or beginner traders to be precise, usually expect price to bounce again from that level whenever equal highs are found. It's true that sometimes, price is going to get rejected, just like here. You can see that price got rejected from this zone. Here, price had a false breakout, or what looked like a false breakout initially, and then eventually that equal low was breached. All right, so in some cases you're actually going to have price respect that level, and in some other cases price is not going to respect that level. So these zones act as liquidity pools, okay, especially when you are talking about the smart money concept. These zones act as liquidity pools, clusters of stop losses sitting just above for the equal highs. When someone enters a sell trade around here, where do you think they're going to set their stop loss? They're likely going to set their stop loss somewhere above the equal highs, right? So that is the reason why these areas are areas of liquidity pools. They are zones of liquidity pools because you have clusters of stop losses for sell trades above the equal highs. You're going to have clusters of stop losses for buy trades below the equal lows, right? And institutions know this. They know that when the majority of retail traders see a double top, they either take short positions or place their stops just above it. All right, you will either enter a sell trade and place your stop loss above this, or you enter a buy stop. Maybe you place a buy stop limit, that is a pending order, a buy stop pending order, not necessarily a buy stop limit. Okay, it could be a buy stop limit, or it could be just a buy stop pending order above the equal highs. Or you might enter a buy trade here, set your stop loss below the equal lows, or you set a sell stop or pending order below the equal lows. And institutions know these things. That's where the game begins, right? When price breaks above an equal high, retail traders think it's a breakout. Let us look for another instance, because there are some times when that breakout is just going to be a false breakout. So I just want to look for a very, very good example of such a scenario. All right, let's be very practical about this. I need to find a very good example. Okay, guys, so can you see what happened here? Can you see this zone, right? You can see this zone around here. Can you see this? So now we have an equal low around here, right? Retail traders will assume that whenever price gets here, it's likely going to get rejected. And quite all right. You can see at this point, price got rejected. At this point, price got rejected. But if you notice, the move, we are not all that big. Okay. In this case, we actually had a reasonable move, from here to here. And in this case, we had a smaller move. Okay. But in this particular case, there was a breakout. And guess what, when a breakout happens, retail traders will assume that it's time to sell, right? You'll assume that it's time to sell, and then they end up entering a sell trade, and instead the price reverses. Now you can see that just shortly afterward the price reversed. Now that move was not a breakout, it was a liquidity grab. Okay, it is engineered to hit stop losses, because when you enter a buy trade, ideally your stop loss is going to be below the equal lows, right? Your stop loss is going to be below the equal lows. So the institutions know this, and when a retail trader enters a buy trade or enters a sell trade, if he assumes that this is if he assumes that this is a breakout, and he enters a sell trade, or maybe you even use the pending order, you enter the sell stop, and then your sell stop gets triggered, and before you know it, the price reverses and you end up in a loss. Or maybe you enter the buy trade and you set your stop loss around here and you get stopped out, and then the price reverses. So this activity, this activity is done to fill large institutional positions at the best possible price. Okay, the same thing happens with equal highs. This is the case of equal low. The same thing happens with equal highs. Smart money drives the price higher, above the level, absorbs all the buy side liquidity, then reverses down. Right? So these aren't coincidences, they are calculated. So how do you trade equal high and low liquidity? Here's a simple breakdown for you. Okay, first of all, you need to identify equal highs or lows on your chart. Price levels where two or more wicks tap the same area, just like these few instances that we have shown on the chart. Okay, you need to first of all identify these equal highs and equal lows. Then you wait for a sweep. Okay, a candle that breaks past the equal level, taking out liquidity. Wait for that sweep to happen first. All right, then you wait for a shift in market structure. Once, for example, let us use this one that took place as an example. Once price has broken through that equal high or equal low, watch out for what happens next, because there are situations where the breakout might be valid. Other situations, it might just be a liquidity sweep. Okay, so what you need to do is to watch out for a shift in market structure. Once price breaks structure in the opposite direction, you now have confirmation that the liquidity grab is complete. So now what does that mean? When you have price break through this equal low, as price broke below this equal low, yeah, the next thing for you to do is watch out for a break of structure. What we mean by a break of structure is, remember that when price is forming lower highs and lower lows, when price is forming lower highs, and lower lows, it is a sell trend, right? When price is forming lower highs and lower lows, it's a sell trend. But if suddenly after this breakout from an equal low or an equal high takes place, after such a breakout takes place, the next thing for you to do is watch out if you are going to have a break of structure or a change of character. In this case, a change of character, meaning instead of having equal high lower highs and lower lows, you will suddenly have a higher high and a higher low. So that is what happens here. You can see we had a higher high and a higher low. You can see this low is higher than this other low, right? So in this context, you can see that it is a sign that a liquidity grab has just taken place. Okay, sorry about this. Yeah, so that was a sign that a liquidity grab has just taken place. But if you do not see a change of character, that is, if you do not see price form a higher high and higher low after a series of lower highs and lower lows, then it's possible that it is a legit breakout. All right. So once you have identified that shift in market structure, the next thing for you to do is to enter on the retest of the breaker block, the order block, or the demand and supply zone created by the move. So right after we have this, change of character, um, okay, in this case, the change of character actually happened here. All right, you can see because this was still, you can see that this was still lower than this, right? But we had a higher low here. So this higher low was what changed the narrative. We had a higher low here. So this changed the narrative. So after this higher low, as price came up and formed another higher low, as you can see here, you can see that we are having a new structure form here. We are actually having a new structure form around this liquidity zone, right? We're having a new structure form around this liquidity zone. So this was a sign to look for buy opportunities, all right? So once you get such a structure, you can then enter once you have a confirmation, probably from a bullish candlestick pattern. That is in the case of a buy trade. Obviously, if it's a sell trade, you're looking for bearish candlestick patterns. All right. Now, why does this work so well? Because most traders react emotionally. They see clean highs or lows and assume the market respects those zones. Institutions create those clean levels on purpose, right? They want the chart to look obvious. That's how they bait retail into overconfidence, then hit them where it hurts, which is their stop loss. So once you begin thinking in terms of liquidity, you stop reacting to the market and start anticipating what the big players are doing. So keep this in mind. Equal highs and lows are not the signal, they are the setup. Okay, the signal comes after the liquidity has been taken and the market gives a clear reversal structure. So study your charts, look at how many times price wicks above clean highs, reverses, and never looks back. Okay, that's not noise, that is strategy. If this opened your eyes to a new way of trading, don't forget to like this video and subscribe to the channel. We drop breakdowns like this frequently. No fluff, just facts. Okay, so thank you for watching and I look forward to seeing you in the next video. Happy trading.